Hello and welcome to this session in which we will discuss compensation of owners. Owners of businesses, they need money to survive. They have bills to pay, they have maybe kids, they need to send to school, they need to save for their retirement, they need to pay for health insurance. If their business is the only source of livelihood, if that's all what they do, in other words, they don't work for a company, they don't have a W-2 income, so the only income they have is self-employment income, then they need to be compensated. The method by which business owners are compensated, well, it has different tax consequences according to the business legal structure. Therefore, from a tax planning perspective, when you are advising a client, a client means a customer, what's the best way to organize a business? Well, you have to ask them a few questions. Are you in need of getting a salary on a regular basis? Well, if the answer is yes, then we have to look at the most optimal structure for this compensation. Because the choice of compensation not only affect how much you take home as a net amount, but also affect tax responsibilities in terms of FICA taxes. FICA taxes are Social Security taxes and Medicare taxes, and the way fringe benefits are taxed. Now, what are FICA taxes and fringe benefit? We're going to discuss them shortly. But the point is, how you are being taxed depend on your business legal structure. Remember, you can operate your business as a sole proprietorship. You can operate a business as a partner if you have more than one owner, S corporation, C corporation, LLC, so on and so forth. So this is a crucial aspect in considering when determining which business legal structure I need to formulate, I need to work under if I need to do what? Get a compensation as an owner from the business. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. First, we're going to talk about self-employment tax. And self-employment tax, I cannot assume you know it, although you should if you took regulation. But self-employment tax is a tax required by the IRS for people who are what? Who are self-employed, working for themselves. Now, what's the difference if you work for themselves or if you are an employee? Let me explain to you if you are an employee. If you are an employee means if you work for a company. Employee versus employer, okay? So if you are an employee, let's assume you work for a company. Here's what's going to happen. If you work for a company, and if you look at your paycheck, you're going to see Social Security tax is 6.2% deducted from your paycheck. You will see that the Medicare tax is 1.45% deducted from your paycheck. That amount you pay every time you are paid, up to a certain amount. We're going to discuss about the limitation, but those are the rate. Now, what you don't see on your paycheck is your employer, your ER. The company that you work for also pays 6.2%. Also, your employer will contribute for 1.45%. Well, between the employee and the employer, between the two, the Social Security tax is 12.4%. The Medicare tax, 2.9%. Together, which is, we call both of them FICA, they are up to 15.3%. That's assuming what? Assuming you are an employee. In other words, you work for a company. Well, if you don't work for a company, if you work for yourself, guess what? You are responsible 100% for Social Security. And how much is Social Security? 12.4, because you have to pay your share as an employee and your share of your company. Medicare taxes, 2.9%. Why 2.9%? Because you have to pay your share as an employee of the company and the share of your company, 1.45%. Therefore, FICA in total for self-employed individual is 15.3. Now, you will get a deduction for that, but we'll talk about the deduction later. I just want to make sure I lay the grounds. Now, make sure that self-employment tax applies if you're self-employed once you exceed $400 in net earnings, it means revenue minus expenses. Now, when it comes to Social Security, yes, the rate is 6.2. However, the amount that you pay in Social Security is capped. In other words, you don't pay Social Security on all your earnings. For example, in 2024, and this number will change from year to year, rest assured. So if you're looking at 2026, 2027, 2025, or any year other than 2024, this number changes. Now, the Social Security tax applies to earnings that exceed $400. So once you make then more than $400 in net earnings is revenues minus business expenses. If that amount equal to 400 or more, you start to pay Social Security tax. And once you reach 168,600, you stop paying Social Security tax. However, Medicare tax apply to all net earnings from 0 to 10 to unlimited. I'm not going to say 10 million. You think there's a cap. There's no cap on Medicare taxes. So self-employed individual pay this tax through their annual tax return, contributing to their Social Security benefit coverage. So the reason you pay Social Security and Medicare tax is when you retire, you have coverage by the government in terms of retirement income, in terms of healthcare coverage. So when I say self-employment tax, we know what self-employment tax is now. As I mentioned, if you are an employee, you pay it. But if you are self-employed, you pay your share. As an employee, you pay your company share. It's double. So pay your employee plus your employer, and that's why the rate are 12.4 and 2.9. But the Social Security, if you're an employee, 6.2. Your employer pays 6.2. Now, let's talk about fringe benefits. Those benefits are additional compensation provided to employees in addition to the regular salaries. What would they include? They would include something like healthcare insurance, life insurance coverage, retirement plan contribution, maybe using the gym, maybe they'll give you some extra money to park your car in the city. Those are called fringe benefits, extra compensation. Now, how these compensation are treated for tax purposes differ. The tax treatment differ across different business structure, whether you are self-employed, you have a Schedule C, whether you are self-employed, a partner in a partnership, whether you are self-employed and you are a shareholder in an S corporation or a C corporation. It affects both the tax deduction for the corporation and the tax obligation of the employee. So, but when I discuss fringe benefits, I don't have to define them, just know those are extra benefit. Now, what I'm going to do next is take a look at different business legal structure and determine how self-employment tax and fringe benefits are treated for both the business entity itself as well as the employee/owner. Starting with corporations, again, once we mention corporations, we assume we are dealing with C corporations. So owners of corporation paid through salaries if they work as an employee in addition to receiving dividend. So if you are you can be owner/employee in a C corporation. So the owners can be employee. The owners, they can also get paid a W-2 from the C corporation. Because they have, basically you have an employee-employer relationship, it means the corporation is responsible for covering 1/2 of the Social Security. So if you set up your company as a C corporation, or if you are a member, if you are a shareholder in a C corporation, and you are an employee of that company, the corporation pays 1/2 of your Social Security, 6.2, you pay the other 1/2. Now let's think about it. If you own 100% of the corporation, basically you're paying everything because you're the employee and the employer. But generally speaking, here we're talking about being a member, but you're not the only member. But nevertheless, that 6.2 is coming out of your earnings because you are owner in that company. So you pay 6.2 in Social Security, you pay 1.45 in Medicare, and the corporation pays the FICA tax as well. Now, the corporation, because they pay, what can they do? Those are called payroll taxes. Well, how about if something called payroll taxes for the company? Well, that's deductible. So the company can deduct whatever they pay on your behalf. It's a payroll tax expense. That's an expense for the company. Now, bear in mind, as a shareholder, you could also get dividend. Now, dividend are taxed differently. Dividend are taxed at 0, 15, and 20%, depending on your tax bracket. And they are not subject to payroll taxes. So when they give you a distribution in form of dividend, dividend is different than salaries. Well, salaries are ordinary income, subject to ordinary tax, individual tax rate, dividend 0, 15, and 20%. So the salary is considered ordinary income. for the shareholder employee and subject to regular income tax rate, just like if you're an employee for another company. However, you are an employee for the company that you own part of it or you own all of it. You can be an employee. How about if you have fringe benefits as part of a C corporation? As long as the fringe benefits are qualifying fringe benefits and provided to you, they are deductible. Simply put, if the company is paying health insurance on your behalf, if the company is providing you with life insurance, if the company is providing you with extra incentives to work for the company, that's an expense for the company, and it reduces the taxable income of the company. It's a business expense. And these benefits, that's the most important thing about them. As long as they are qualified, they are not considered taxable income for the shareholder employee. Now, again, you should know what fringe benefits are. There's a whole session about them on the reg exam. Now, this is TCP. So this is a tax efficient way to compensate the employees, because you are giving them benefits and you're not adding those benefits to their W-2. So that's great. That's a plus for corporation, because you can get fringe benefits. The corporation pays for it. The corporation can deduct this. It reduces the taxable income. It reduces the tax bill for the corporation, and it's not taxable to you. So this favorable treatment encourages C corporation to offer what? Benefit packages to their shareholders/employees, owners, enhancing overall compensation package without burdening the employees with additional taxes. So that's a plus for having a C corporation. How about if you have an S corporation, S as in Sam? Well, this corporation passes their income, remember, deductions and credit through the shareholders. That's why their S corporation is a pass-through entities. So they pass those through a K1 then those K1 information go to the personal income tax return. Now, also, you can be an employee of an S corporation. So salaries paid to shareholders employee, means you're a shareholder and employee at the same time, reduces the corporation pass-through income, because the salary expense is an expense. It's a salary expense that reduces taxable income for the S corporation, lowering their taxable income reported to the shareholder. Now, bear in mind, S corporation, it's important that S corporation pay shareholder a reasonable salary. Why? Because you cannot pay all the earnings to the shareholders and call it salary. Why? Because if that's the case, we talked about this with C corporation, the IRS might say you are paying them, and this is going to be reclassified not as a salary, as a withdrawal. So you cannot pay everything in terms of salary. So you have to be careful. But this system incentivizes corporation to do what? Employ their shareholders. So you can deduct their salaries, but those salaries must be reasonable and justified. How is it reasonable and justified? Well, if you're paying someone $250,000 salary, is this reasonable and justified? Well, you look at their position. You would look and you would say, well, if I need to hire another individual to do the same type of work that this individual is doing with their qualification and experience, do I pay them $250,000, or I can get someone for $100,000, or do I need someone for $400,000? So that's how you would determine, if you are audited, whether those salaries are reasonable. And we discussed this when we talked about S corporation. How about fringe benefits if you're a shareholder employee? Well, the tax implication for fringe benefit, same thing for corporation. When it comes to the corporation, they can deduct the cost of fringe benefits similar to C corporation. Now, this is the corporation similar. However, how about the person that's receiving the benefit? The shareholder/employee, the owner. Well, here it depends. If the shareholder employee owns 2% or less, what does that mean? It means, yes, you are a shareholder, but you own 2%. Basically, you own a small percentage of the company. Well, under those circumstances, those fringe benefits are not considered taxable income. Well, here we are still following the same rule as C corporation. So someone with less than 2% ownership in that S corporation, the corporation pays their health insurance coverage. Great. S corporation can deduct this, and it's not taxable to the employee. Now, for shareholder employee owning more than 2%, guess what? The benefits are taxable and must be included in that shareholder income. So if they pay health insurance on your behalf, well, they're going to get a deduction. That's good news. And it's going to reduce the taxable income for the S corporation. However, that money gets added to your K1 saying you're responsible for that. You're responsible for that. Well, all to your wages, and you're responsible for that. So this distinction, the goal of it is to prevent larger shareholders from receiving tax-free benefit not available to smaller shareholders, ensuring a more equitable tax treatment. Otherwise, what's going to happen? The large shareholders, well, they will get all their benefits through the S corporation at the expense of other smaller shareholders. So this is about S corporation. How about if we're looking at sole proprietorship? We have one individual, one person operating the business. What do we know about this from a tax perspective? Owners of these businesses don't receive a salary because you and the company are the same individual. No traditional salary or fringe benefits. Instead, all the income goes to your Schedule C. It goes to your 1040. Also, if you make more than $400, your income is subject to self-employment tax, which is Social Security and Medicare. We talked about self-employment tax earlier on, and this encompasses both the employee and the employer part. Now, bear in mind, because you are the employee and the employer, here's what's going to happen. You're going to take 100% of your earnings minus 6.2%, which is the Social Security rate for the employee, 1.45%, which is the Medicare for employee. So what's going to happen? Your earnings minus 6.2 minus 1.45%, what's left of your earning, 9.35%, and that's subject to the SE tax. Now, why do they do this? Because since you are paying both the employee and the employer, they're going to give you a deduction for your employer portion, because you are the employee and the employer. Therefore, you don't take all the earnings times the Social Security tax. You will take only 92.35 times the 15.3%. So I just want to make sure you remember this, and I want to show you why does it come down to 92.35, because what the government is saying, yes, you are paying both, but we're going to give you a break on the, in quote, your employer. You and the employee and the employer are the same. They give you a break, which is fair because you are paying taxes on your behalf and you are paying taxes on your company's behalf. How about partnership? In a partnership, unlike corporations, you cannot be an employee. So if you're a partner, you're an owner of the business, but you cannot be an employee. You cannot hold the status of an employee. You don't get a W-2 from your partnership. So what do? You need to live. If you're a partner in a partnership, here's what's going to happen. Instead of a W-2, instead of wages, you would receive something called guaranteed payments, which are fixed amount for services you provide to the partnership, regardless of the partnership profitability. The partners will agree among each other how much they want to get of guaranteed earnings. So these payments are made to do what? To compensate partners for their contribution. You might be spending time to do what? Working for the partnership, operating the partnership. And guess what? This guarantee payment are deducted from the partnership income before calculating ordinary income, which is ordinary income goes to you and it's taxable to you, but that money is deducted. However, guaranteed payment are treated as ordinary income to the receiving partner and subject to income tax. Also, because partners are not considered employee, there's no division of Social Security and Medicare taxes. So what does that mean? It means the partner is responsible for paying the entire Social Security and Medicare, well, with that self-employment tax. This means the partners must pay both the employee and the employer portion of their taxes on their guaranteed payment income. How about fringe benefits? Well, in a partnership, fringe benefits like health care insurance, life insurance, any other qualified benefit are typically incorporated, added into your guaranteed payment. What does that mean? This means that the partnership can deduct the cost of these benefits, but for you, ordinary income. They deduct it, then they add it to you. As a result, partners must include those benefits in their personal income, subject to income and self-employment taxes. And the setup aligns basically with the principle that partners are not employee and thus receive compensation and benefit tied to their partnership agreement. That's what a partnership is. You're a partner. Now, how about you're an LLC? Well, depending on how the LLC is structured, well, the LLC could be taxed as a sole proprietorship, partnership, or a corporation. If it's taxed as a sole proprietorship or a partnership, members take profit directly and pay self-employment tax. It's a flow through. If it is an LLC taxed as a corporation, remember LLC, you could choose whatever you want to. If you decide to go with a corporation, members can be paid salaries as employee subject to payroll taxes. Let's summarize basically what we just learned so far, just kind of an overall perspective. Both partnership and sole proprietorship do not allow traditional employee-employer relationship. In other words, you and the company are the same individual. There is no separation. These business structures use mechanisms like guaranteed payment or direct profit allocation to compensate their owners, who then bear the full responsibility of paying self-employment taxes on their income. Remember, although you're paying the self-employment tax, the government will give you a small break the 92.35. And this setup, well, it's fair because it shows the direct connection between the owner's work for the business and their compensation. And they're responsible for that money that they're getting. Bear in mind, for C and S corporation, you can be an employee. And what's going to happen? The company will pay half of your Social Security, half of your Medicare. Okay. These advantages might influence the choice of entity type based on the potential for tax savings. Again, this is looking at compensation and business structure from one single angle, and that's how does compensation is treated under different legal structure. Let's take a look at this multiple choice question from farhatlectures.com. A partnership provides health insurance benefit valued at $10,000 to each partner. How does this affect the partnerships and the partnership taxation? So if the partnership is paying your health insurance, how does the partnership treat this expense? If it is an expense, it's going to be deducted. How about the partners? Okay, the partnership deduct $10,000 and the partner pay no taxes on these benefits. Can the partnership deduct $10,000? Yes, it can. And the partners pay no taxes? No, the partners are responsible for something. A is out. The partnership cannot deduct the $10,000. Yes, they can. It's a business expense. The partnership deduct $10,000 as guaranteed payment. Yes. And this amount is taxable income to the partners. Yes. If they pay fringe benefits on your behalf, they can deduct. It gets deducted on the partnership return on the 1065, but this amount is reported to you in form of guaranteed payment, and you're responsible for paying taxes on it. Let's just take a look at D. The $10,000 is non-deductible. It is deductible. I don't have to read the rest of it. The answer is C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, Farhat Lectures, additional resources. That's going to help you whether you're studying for your CPA exam, enrolled agent, income tax course, or any other professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.